A collection agency can be defined as a third-party organization that teams with another company to help collect on past due receivables. In most cases, there are three types of collection agencies: those that collect strictly from individuals and are labeled as a retail agency, those that collect from businesses and are labeled as a commercial agency, then those that collect from both. This video will explain the difference between these types of agencies and the benefits of utilizing an agency to help with troubled accounts. Retail collection agencies are the most popular type of agencies in the industry. American consumers are estimated to have $11.13 trillion in debt, $849 billion from credit cards, $7.81 trillion in mortgages, and $996 billion in student loans. With the average household consumer debt profile totaling close to $200,000, it's easy to see why retail agencies have such a presence in our country today. There are typically two types of creditors that utilize retail collection agencies: secured creditors and unsecured creditors. A secured creditor can be defined as a lender who holds legally enforceable claim on a borrower's assets of a liquidation value equal to or greater than the loan amount. Secured creditors are entitled to receive the proceeds of the foreclosure sale of the pledged assets, and in case of a bankruptcy must be satisfied before the unsecured creditor. For example, mortgage lenders, auto lenders, commercial loans from a bank that require a form of collateral, these are all transactions that are recorded on a borrower's credit. Third-party collection agencies are often utilized when these types of debt go to charge-off status. In most cases, secured creditors have a stringent in-house collection effort and will only turn an account to collection agencies once they have exhausted all efforts internally. Retail agencies usually have the ability to report the borrower credit as being placed for a collection effort. This will affect the borrower's credit negatively in two ways: one, when the account is charged off by the secured creditor, and two, when the account is reported as a collection account. Now, an unsecured creditor can be defined as a creditor who extends credit to a debtor without collateral security. If the debtor files for bankruptcy or is levied upon, the unsecured creditors are paid on a prorated basis only after the claims of all secured creditors are satisfied. Third-party collection agencies are often utilized sooner in these scenarios, considering the risks that unsecured creditors have when giving credit terms. Most secured creditors who supply to businesses have the necessary collateral in place. If that business defaults, they are capable of recovering that collateral. When a business falls behind with an unsecured creditor, it is unlikely the creditor will be able to recover the product and is impossible to take the service back. Due to these circumstances, having a third-party commercial agency to turn to is extremely valuable and oftentimes absolutely necessary.